and welcome to our webinar on moving beyond spreadsheets. My name's David Fennell and I'm joined by my colleague Kieran Garriger. Good afternoon, Kieran.
Good afternoon, Dave, and welcome to everyone that's joined.
So thank you all for joining us in what is probably your lunch break. Today we're going to be talking about how finance teams can spend a lot of time undertaking manual processes, often in spreadsheets. And what that can mean is the finance team can be really stretched. It may mean that there's not capacity to produce some of the information that the business is asking for, whether that's not being able to produce it at all or not being able to produce it as frequently as is desired. More generally, it can mean the finance team doesn't have time to spend on some of those higher value add tasks because they're spending so much time just trying to pull the numbers together and make sure that they're right. What we've been seeing over the last few years is that businesses and finance teams are looking at different systems for their core processes around planning and reporting that are not spreadsheets. So systems like adaptive planning. And that's what we're going to talk to you about today. So the way we're going to run this session is that we will spend quite a bit of time looking at adaptive planning, the product. We'll give you a demo which Kieran is going to run. But before we get into that, we want to give you some background and some context. So we're going to talk about our journey to adaptive. And by our journey, I mean Pitcher Partners. We're going to talk to you about what adaptive is, how it works, and why clients, businesses should use it. And we're going to talk to you about some clients that we've recently implemented adaptive for. And then we'll get into the demo and we'll have time for some questions at the end. Now, in terms of questions, you can post them as you go via the Q&A pod, which you should be able to see at the bottom of your screens. We may try and answer them as we go. Otherwise, we'll cover them off at the end. Please also note today's session will be recorded and the slides and the recording will be sent out to everyone within 3 business days. Okay, so in terms of our journey to adaptive, Kieran and I work within the consulting team at Pitchers, and we offer a range of financial, technology and management consulting services. My own background is in accounting and finance, and one of the services we offer, and I spend most of my time in, is financial modelling. So we build financial models for our clients. Now, there's 2 broad reasons that our clients ask us to do this. The first one is that it often relates to an investment or a finance decision. So from an investment perspective, it may be that a client is acquiring an asset or another business. They may be participating in a tender, or they may be looking to assess a potential project and they require a model to inform that investment decision. From a finance perspective, clients will often need some modelling as part of their application to a bank or financier. The other main reason we get asked to build models is where a client has a particular process, and often it's their budget or forecasting process, where they run that themselves internally, but sometimes they'll come to us and ask us to build them a nice, slick financial model based on their individual requirements, and then they'll then take that templated model and use it on an ongoing basis to run their budgeting and forecasting process. And we've always done this kind of work historically in Excel, and a lot of it we will continue to do in Excel. And I guess I say that to kind of highlight that is our background using Excel, and I'm sure that's the same for a lot of people on the webinar today. But what we started seeing over the past few years, that increasingly our clients were considering solutions other than spreadsheets. And about 3 or 4 years ago, we ran a system selection for a client who was looking for a budgeting and reporting system. Now, adaptive planning participated in that system selection, so they were part of the tender and they were ultimately successful. That gave us some insight into adaptive And the more we looked at it, the more we could see that it was a product that was relevant to some of our clients and could add a lot of value to some of our clients. And ultimately, the more we looked at it, we kind of came to the conclusion that this was something that we wanted to be involved with. And we became a partner of Adaptive, and we now do implementations of the product for our clients. So what is Adaptive? I'm going to keep this fairly high level to start with, and we'll get into a bit more detail, and then ultimately you'll get to see the product in the demo. So Adaptive is a cloud-based budgeting and reporting system. It was originally founded and developed by a CFO who was frustrated at the lack of good tools to solve management problems. So he was someone who, like a lot of us, was a big fan of Excel, but got frustrated that it wasn't good at certain things. So he, along with some others, founded Adaptive Planning to try and address these problems back in 2003. And it's grown a lot since then. And it was actually acquired by Workday in 2018. One way to think of Adaptive is that it's an alternate to Excel. So it can replace spreadsheets that are used for some of the kind of core processes within finance teams, namely budgeting, forecasting, and reporting. So it's a good way to think about what Adaptive is and does, is that it's an alternate to Excel. Adaptive is a leader amongst its peers, and I've got some information I'll show you on the next slide that highlights that, but they have over 4,700 customers worldwide, and they have over 300 customers in Australia. So I've got a couple of independent rankings here of Adaptive amongst their kind of peer products, which have been prepared by G2, which is on the left, and Gartner on the right. They both have this quadrant style ranking, and the axes for the G2 and the Gartner ones are slightly different, but basically you want to be in as far in the top right-hand corner as you can, and you can see in both of these that Workday Adaptive Planning is either the leader or within the leading group of systems. So how does Adaptive Planning work? I mentioned that I'm an accountant, or my background's in accounting, so I'm going to try and give the accountant's explanation here. What I probably don't need to say this, but I'll start by saying that it's not an accounting system. Doesn't have general ledger. What it does have or do, though, is that it sits on top of accounting systems or other systems, and it can pull in whether it's general ledger information or transactional data. And it can also sit on top of other systems, so it doesn't just have to be accounting systems. And what it does with by tapping into that general ledger or transactional data is it can then report on it, or it can feed it into modelling processes, whether that be annual budgeting, forecasting, three-way modelling, but other modelling as well, not necessarily financial. So it might be debt covenant modelling, workforce planning, costing for manufacturing, demand forecasting, just some examples of what you can do in Adaptive. We like to say and explain that Adaptive has spreadsheet-like capability. And the reason we draw this out is because when we're demoing the product, we often get a question, but will it be able to do this? And usually that relates to a client has a specific often formula that they use in their own modelling, and they're not sure that Adaptive will be able to handle that. And we make the point that most often it has spreadsheet-like capability. You can build specific functions just like you would in Excel. Adaptive also has very powerful reporting. So it has reporting that is both within the cloud-based system, but it also has some really good features called Office Connect. And what that does is it allows you to build the same reports that you can build in the cloud-based system within Excel, and also has some functionality with Word and PowerPoint. Now, what that, we'll show you this in the demo, but what that is really good for is where you've got some standing monthly management reporting packs or board packs, which you can set up and be really efficient at preparing from month to month. The reporting is all drag and drop style functionality. So it's controlled by the user and it doesn't need IT to set it up. And it's got the kind of standard financial reports that you would expect, but it also has some dashboard style reporting. And again, we can show you that in the demo. The last thing I wanted to mention in terms of how Adaptive work is that it's powered by some technology which Adaptive refer to as the Elastic Hypercube. I always kind of laugh and wonder, what exactly that means, but what's important to understand is that it is very powerful, it's scalable and flexible, and the key kind of thing there for users of the system is you don't need to worry about the number of scenarios that you want to run or the number of versions that you need in your modelling, the number of dimensions you need in your reporting or your modelling, or even the number of reports. Adaptive can handle that, and it's not something that users need to worry about. So in terms of why businesses and finance teams would consider using adaptive planning, there's kind of two key business problems that we identify out of the finance team, which often lead to consideration of adaptive. And I'll talk to these, but they both link back to really a desire to build capacity or gain efficiency within the finance team. So the first business problem is that there's often a requirement to consolidate numerous, whether it's entities or accounting files, or it could be other sources of data. Sometimes this is the result of M&A, but there is a requirement on a regular basis to consolidate data across systems, and that takes up a lot of the finance team's time. The other common problem we see is that businesses that have quite a complex budget process that is based in Excel across many different spreadsheets, and it's really outgrown that Excel process. Now, when I say complex budget process, the complexity often comes from two areas, and this is where spreadsheets don't necessarily handle well, and that's where you've got many spreadsheets that are interlinked, and you've got many managers or contributors to the budget or planning process, and that comes with issues in terms of sharing those files, version control, managing edits, etc. So there's some of the kind of common business problems that are typical and can lead to considering adaptive. The benefits, I guess, you can expect from adopting a system like Adaptive is that turnaround times for reporting and planning cycles will reduce. This means that there's more time to prepare information that previously there wasn't time to prepare. And more broadly, the finance team gets more time back to spend on value-added tasks. All right, so I just wanted to talk, before we get into the demo, just talk briefly to a few clients that we've recently implemented Adaptive for. And the first one is a cleaning company based here in Melbourne, but operates across a few different states. They were drawn to Adaptive because of their complex planning process. So they have over 200 cleaning contracts, and they actually prepare a budget, a P&L budget for each cleaning contract, and that rolls up into a region of which there are dozens, and that rolls up into a portfolio of which there are 3. And then above that, they have different levels of corporate or departments that they also have budgets for. And they had over 50 people within the business that were contributing to this annual planning process. What that meant was that they were having all sorts of problems managing, I think there was over 50 different models, and they had this network of linked spreadsheets. And it was a system or was a process that had worked quite well at a time, but the business had really outgrown it, and they were conscious of an increased risk of error, and it was becoming a really significant burden on the finance team, and more so each year. So this client actually originally approached us and asked us if we could build a better financial model for them, and we said perhaps, but you should consider Adaptive as well, and that's the path that they went down. So in terms of the work we did for them, we helped integrate Adaptive into their general ledger and bring in the general ledger and transactional data. But the key piece of work was really building this P&L planning and budgeting models across their different sites, regions, portfolios, and different levels of corporate. We also built some reports for them within Adaptive, so some standard financial reports, but we built some specific dashboard reporting for their operations team and also for their executive team. Another client we've recently implemented Adaptive for is a transport company. Now, they had, at the time of looking at Adaptive, they had just acquired a peer transport company or a competitor, and that had roughly doubled the size of their business. It also meant they all of a sudden had two of every system, including their accounting system. So they had a requirement to consolidate not only across numerous entities, but two different accounting systems. Because of the acquisition, they had a new bank, and they had a requirement to provide consolidated reporting on a quarterly basis and to provide debt covenant reporting on a quarterly basis. And they needed to provide a three-way budget model once a year. And a lot of these requirements were new for that business. And as a result of those requirements, the fact that they had two accounting systems and just the growth in the size of the business, they were really looking to corporatise and be more sophisticated in their reporting and planning. So we helped this client to integrate with both of those accounting systems. We built their modelling across their different departments. They also had the requirement for a three-way model for the bank. So we built out their balance sheet and cash flow forecasting and helped them build debt covenant reporting to report on their actual debt covenants and also forecast those debt covenants. And we built them a suite of financial reports. I'll just touch on one more client which we're currently implementing, and this is a Victorian home builder. The work we did is quite similar to the last two I've spoken to, but I'll just talk about what led them towards Adaptive. So again, they had quite a complex planning process. Again, I think they had over 50 different Excel models, which were all linked to each other, and they had the requirement to collaborate with different contributors in the business. And there's a similar story that was becoming increasingly difficult, and it took up a lot of the finance team's time. So the frustration that was coming from the finance team was very much around it was soaking up so much resource. From the executive team and to some extent from the board, there was frustration around not being able to get the information that they needed. And a lot of that was around not being able to consider different strategic scenarios fairly quickly. And you can imagine as we went into COVID last year, that just became more important. And that ended up really providing the impetus to move towards Adaptive. All right, I'm going to hand over to Kieran now, and we can have a look at the product. Just a reminder that you can ask questions via the Q&A pod.
Thanks, Dave. Now, before we dive into the demo, there are a couple of things I want to cover. So let's jump in here. So now, using Adaptive, the planning process can effectively be broken down into three separate phases. First is the data integration, and that is loading the required data into the system. Now, this could be actuals, inputs such as labour rates or fixed assets for the purposes of calculating depreciation. Think about what inputs you need to build up your budget. Now, once we've got some base data in the system, we start the budgeting process. We start to look at what the next 12 months is going to entail. And then there's the reporting function. We can structure and design our own reports using Adaptive's native report writer. We can leverage Excel's add-on to build reports directly in Excel, or we can focus on the visualizations that leveraging Adaptive's dashboard suite. So whichever method that you choose, the purpose is generally the same. We want to monitor performance. Now, there's a direct relationship between each of these phases. We start with the data integration. We bring the data in. Once we've got some actuals data, we plan and budget around that data. Some time passes. We'll then reload actuals. We'll load more current actuals through the integration. Then we report on the variances. We rebudget, forecast, and so on. So it is a cyclical process. Now, my aim today is to briefly cover off each of these functions over the course of the next 15 or so minutes. So let's dive into the first element, and that is integration. Now, I do flag when we start talking about integration, it can get pretty technical very quickly. So today we're just going to cover off some of the key concepts and features. So there's effectively 3 ways we can get data into Adaptive. We could manually key in the data, and I wouldn't recommend this in a high dosage. We could import a flat file such as a spreadsheet, or we can build a connection between 2 applications and integrate them. And we'll have a closer look at this option. Now, Adaptive has some built-in connectors that make it really easy to hook into some very well-known and common systems. Some of these you may recognize on your screen. It doesn't end there though. So we can also build custom connections where they don't already exist. And some of those are listed on the screen now. So typically, most common ERPs or finance systems are underpinned by a JDBC database. So very easy to build a connection between that to feed the data into Adaptive. We can also connect to a custom cloud data source, such as a Xero. Or perhaps for more complicated solutions, we can always use custom scripting, or as a last resort, we can always tie into an Excel file. So there's plenty of options to get your data into Adaptive and as efficiently and streamlined as possible. So hopefully this slide has given you a bit of a sense of Adaptive's integration capabilities without actually physically seeing it. Now, I would like to move on to the budgeting and actually show you some of this functionality, but there are a couple of key concepts that we have to cover off first, just to give you a bit of a feel for how everything sits within Adaptive. So in Adaptive, data is built or data is stored within Adaptive on this notion of being at the intersection of an account, a time, a level, and a version. And so what we mean by that is, by an account, we typically mean a GL account, or in Adaptive, we can create our own custom or assumption accounts to store variables and other sorts of information. Time period could be a day, a week, a month, a quarter, a year. Basically, it's a defined period of time. The level is one way that we can categorize or segment data. So for multi-entity organizations, we may create a level for each entity and have another level that's a consolidated group or parent level at the top. Or we could be using levels to split cost centers or projects, departments, states, anything really. And our last element there is our versions. And I like to think of them as scenarios. So your actuals data gets loaded into Adaptive in its own version, and that is the actuals version. We can create another version for our budget, another version for our forecast, and we can, I guess there's an unlimited number of versions that you can create. So very easy to create those scenarios and do all sorts of scenarios within Adaptive. So to bring all this together, let's use an example. If I had a rent expense for March 2021, it related to a particular site, and it was an actuals figure. Within Adaptive, we just store that $2,000 value. And how we can then do some variance analysis is all we need to do is just pull one lever, change one of those elements, and we can compare one figure against another. So, for example, if I was to just change the time period and look at March 2020 and compare that to March 2021, it's very easy to just do a simple comparison between one element by changing one element or changing many. So now that's really all I wanted to cover off in the slides. So let's jump into Adaptive and give you guys a look at how it all works. So I've just loaded, I've preloaded some tabs just to get through as much as I can in the short space of time that we've got you for. But this is the typical landing page within Adaptive. As Dave said, it's a cloud cloud-based product, so it can be accessed on ultimately any sort of device that's got an internet connection. But effectively, what I want to take you through first, we want to continue down this pathway of budgeting, or planning. So I've just loaded up an income statement. So you should see this on your screen. And some of the elements that I talked about earlier, I'll just point them out on the screen now. So in the top right corner, we can see we're looking at the budget for FY 2021. So that's our version. The level that we're on is Cost Center 1. It's very easy to go and change the level and roll up or roll down. Our final two elements are in the grid. So running across our columns, you can see our time series month to month. That varies. And then down in the rows on the left-hand side, we can see our GL accounts for which we're budgeting. So effectively, when I click into one cell here, they are the four elements that make up this number that's being stored in Adaptive. The other thing I want to just call out is I'm looking at a standard sheet at the moment. And one of the cool things about Adaptive is in my planning process, I've got actuals to work off. So all of these figures in green to the left are historical and actual figures. So I can't change these because that has happened. Whereas all the cells over to the right with a white background and black text, they're our planned or budgeted figures. So that's what we can play with to map out what the next 12 months or future period's going to look like. So if we step through a couple of examples, I'll show you how easy it is to sort of build up a budget and some of the different options that you've got. So as I described, you can manually feed in data straight into Adaptive. So I can just type straight into here, I want to budget 50,000 for this revenue account for July 2020. And that figure is going to be constant for the whole year. Let's key in now 50,000. I'm going to copy that forward and I'll save that. So very easy to get a figure in there, push it forward or copy it forward, and that's static for the year ahead. Probably not how you're going to do your budgeting. So let's look at another alternative. I'm just going to clear those figures. Let's say that it's probably more applicable to an expense account, but let's say we've got $1 million that we want to allocate evenly across each of these 12 months. So I can just highlight those cells, make sure I've got enough zeros there. I want to distribute that $1 million, adjust that proportionally across the period. And Adaptive does the work for me. So it's basically split that evenly and it's allocated $83,000 to each month in the year ahead. So that's another option. I could go ahead and save that, but I won't. I'll just clear that. Let's have a quick look at some simple formulas. So I'm just going to put one in here for July. So hopefully you're getting a sense that it does feel like Excel. It does have that spreadsheet capability. So where it is a little bit different is there is different syntax within Adaptive. So that is something you do have to sort of get your head around, but it's quite easy to learn. So what's happening basically here is I'm pointing to this same account and I'm pointing to 12 months ago. So this formula effectively we would use if we were trying to budget something that had a seasonal impact. So effectively, I want to look at July 2019 and I want to take that figure and use that figure in July 2020. And if I copy that formula forward, it will do the same for each of the other months. So if August was 55,000 in 2019, I want to see 55,000 in August 2020. So I'm just going to copy that forward and show you how that works. So let's save that and let Adaptive do the work and calculate what values we're expecting to see. So as I said, that formula, if I click into the cell, you can see it's applied that formula to each cell, and we're getting mirrored values from the prior year. Now, if we wanted to get a little bit more sophisticated, let's go one step further with our formula and let's add some CPI. So I'm going to add just hard code 2% in there, which I will apply to all of my formulas in that account. So I'm saving that. And so we shouldn't see 50,000 in July anymore. We now see 51,000 because it's added that 2%. I wouldn't recommend hard coding figures. I just use that as an example, but what I can do, I've got I guess an assumption account that's already been set up, which stores our CPI. So now I'm just building on this or developing this formula a little bit further and future-proofing this. So by referring to this CPI account that I've created, I'll show you. I'm just going to copy that forward, save it. We should see the exact same figures, but the strength here, or the benefit of not hard coding and referring to another account, is if I needed to adjust my CPI figure, I only need to do it in one place. I don't have to go and update all my formulas. I just update it once, and any formula that's calling on that attribute or that custom account or assumption account automatically updates. So very powerful stuff. Now, I guess I wanted to show these examples, and hopefully that demonstrated how easy it is to replicate similar functions that we would otherwise build in Excel. This can be as simple or as detailed as you like. So I've used very simple examples here, but it's very easy to budget or build your budgets based on volume or price assumptions, whatever it is. We can get as detailed or summarize as much as you like. So I guess one of the pros or one of the real benefits that Adaptive, where it can go one better, is just applying consistency across the board. So whichever way you choose to budget an account, we can set these formulas up to apply to all levels or a subset of levels using a master formula. And that means we're getting consistency across all our states or departments, whatever level structure we've adopted. And we don't fall into the trap of having an Excel template where if we change a formula in one tab and we have to go through and update all the tabs or all the workbooks, we can get that consistency across the board. Now, again, these were pretty simple budgeting methods that I've taken you through. Let's take things up a notch and let's have a little bit of a look at three-way modeling and the use of input sheets. So to do this, I have to introduce a new concept now, and we're going to use some modeled sheets. And while Adaptive refers to them as model sheets, I like to think of them as input sheets. They store our inputs. So I'm going to just bring up a report now. We're going to start to overlap a little bit between our budgeting and our reporting now. But that's, I guess, the easiest way to sort of demonstrate our three-way modeling. So right now on the screen, we're looking at a profit and loss statement or an income statement. We only build this report once. Very easy to customize or change the view. So I'm looking at the consolidated group now. I can go ahead and choose a different level if I like, or change the time period. Very dynamic in that way. So that's the first of our three reports in our three-way model. I've got a balance sheet here where on all our reports, we can expand or collapse. So you can see some categories I've already dived into, and you can go all the way down to your GL account that makes up a balance. Our third financial report or three-way model is the cash fund statement or indirect cash flow. So on many of these reports, as you can see, I can click on a figure. If I want to see what's making up a balance, I can drill into that. I can see the levels that are making up whatever value that is producing there. So hopefully that gives you a sense of some of the reporting capabilities. But what I'm going to take you through now is how we can tweak things if we're in our budgeting or planning process as we make changes, what impact that has on our three-way model. So I introduced this concept of a modeled sheet. This is a capital sheet that's now on your screen. And I guess I want to simulate what would happen if we were to acquire a new asset. So we're going to, I guess, put in a purchase for some PPE and see how that flows through our statements. So on this model sheet, we don't have any data in here at the moment, but I'm going to input something now. So here we go. I'm adding a new line. So in this example, what we're going to do is we're going to purchase a new building. Let's say we're purchasing a house. And we're going to spend $5 million on that. I'm going to backdate this purchase. I'm going to put it in October. And we moved in the same day. Very efficient. Cash is king. So let's say we paid cash for that. We don't need an interest rate or a finance interest rate because we're not using the alternative. Finance doesn't apply. So if I go ahead and save that input into our modelled sheet, our capital sheet, let's go back to our three-way model and see what impacts this has had. So on our P&L, we're looking for our depreciation line. So down the bottom here, or towards the bottom, we can see it's 186,000, and that figure was constant throughout the year. I'm just going to rerun the report now because that change that I just made should take effect. And as we can see, between September and October, that depreciation figure has changed. It's leapt up to 206,000, and that's now the depreciation figure going forward, accounting for that addition to PPE. If we have a look at our balance sheet, it will navigate down to the property, plant and equipment line. You can see there we had 5.3 million steady across the year. I'm going to refresh that. And again, in October, we see that kick up. So now that's brought in that extra 5 million for the head office that we purchased in October. So that you can see is the new figure that's going forward from that point. And for our fund statement, I'll draw your attention to our fixed asset movement line. Not much happening there at the moment, just a little bit of movement, but I will refresh that. And we should see, now we see an outflow occurring in October. We can see that 5 million that's hit October, the fixed asset movement. So very simple example of how a change in capital can flow through our three-way model. I'll take you through another common example, and that's financing. We'll go through a bank loan or a facility. So this is another capital sheet that we've set up to store this information. And I've already pre-filled this $10 million loan that we've acquired in July 2020. So we're going to add a new row to this, and we're going to just record some prepayments. Well, not some prepayments. We're going to record a repayment. So let's say that we're repaying this loan. We're going to repay $2 million on a quarterly basis. So I'll go and populate that. So we get that in each of the quarters. I'll go ahead and save that change. Let's go back to our P&L and see what impact that's had. So if we go down towards the bottom, non-operating expenses under other interest, we can see our interest charge was 20,833 across the year. Let's refresh that so that we incorporate the recent change. And now we see the value diminishing over time because as we're making those repayments, our interest charge diminishes. So it's at its lowest point at the end of the year, being 8,333. As for our balance sheet, let's find our bank loans sitting under non-current liabilities. We can see there, because I'd already pre-populated that $10 million loan acquisition, that was in there. However, now we've got some repayments. So let's see that $10 million figure start to change. So now we can see the repayments being incorporated, and it's dropping by $2 million on a quarterly basis as we budgeted. And finally, our fund statement. If we have a look at our line from repayment of bank loans, not much activity happening there, just the acquisition, the 10 million that was already in there. But if I refresh that, we should start to see some more outflows there. So we can see that 2 million hitting September, December, March, and June. So hopefully that gives you a little bit of a sense of some of the three-way modelling capabilities that exist within Adaptive and how easy it is to sort of see those changes take effect. Now, I wanted to just, I guess I've introduced reporting. Let's just cover off a couple of the other things or reporting methods that have been mentioned throughout today. So the first thing I want to just show you is here's a quick report that we could use to do some variance analysis. So perhaps the finance manager's just reviewing at end of month what's happened for the month that's just passed. And what we can see here is under our sales income, we've got a bit of a variance. So perhaps we want to explore what's going on there. So as I said earlier, we can very easily drill down, get down to the GL account that's at issue. And we can see in here, we didn't have a budgeted figure, but we've got some actuals coming through. And actually during this presentation, we did budget in that account. So if I was to refresh this, we would get a new value coming through. So we've got that 51,000 that I'd budgeted before. But we're still out by about 300,000. So that's a bit worrying. So let's dive into this and have a look at what's making up this balance. Adaptive can bring in the transactions, so you don't need to go out and go back to the source and look at the ERP or finance system to I guess explore that value. We can just drill into the transactions within Adaptive, and just scrolling through, having a look. We've got a bit of an outlier here, so given we're out by about 300,000, perhaps we've missed a decimal point there, and that's supposed to be only 3,000, but it's gone through as 300,000. So if I go back to my report, I can add a note to that, say something was miskeyed, please review. And you can see there it's time-stamped and it's put my name in there because I'm logged in. So anyone in the finance team could go in there and then act on that and leave their own comment once the issue has been resolved. We haven't touched on dashboarding yet. I do want to give you a quick sense of how that works. So I've just got a very simple dashboard loaded here in Adaptive. It's like most of the things in Adaptive, it's very, very dynamic. So easy to change the view. I've just changed the time period. You see things refresh instantly. I can get a snapshot of whatever it is I want to be reviewing or looking into. I can change the level if I'm particularly interested in what's happening in Cost Center 1. As you can see, it's refreshing basically instantly and giving me the ability to have all that information at my fingertips. The last thing I just want to quickly cover off is Office Connect. So let's jump out of Adaptive and out of the browser and into Excel. Everybody loves using Excel, or at least everyone that works in finance typically is comfortable using Excel. So the good news is there is still a place for Excel in the new world. I'm going to just run you through how Office Connect works. So I'm just going to log in. There's basically an add-in to Excel here for Adaptive. I'm logging into the environment. You can see at the moment, there's no figures coming through. My data's secure. But now that I've logged in, it's verified that I should have access to these figures. I can go ahead and refresh that. And Excel is sucking that data straight out of Adaptive to show in Excel. And I can go from there and do whatever analysis I want to do and build up perhaps a custom report using the data that's in here and using Excel's native functionality to do that. As Dave mentioned earlier, there's no need to involve IT in this. It is drag and drop. So we can see here, there's no formulas sitting behind these numbers. We really, all we need to tell Excel is what data do you want to bring in? What intersection of data? So this column is returning August 2020. It's returning the version actuals. And I've told Excel that the account I want is sales income. And the level I want to bring in is Cost Center 1. So if I was to click into that value, I can quickly unpack what's actually being returned there and verify that's the figure that I'm looking for. Where this is super useful is this can be really dynamic. I can change the date or have it refresh automatically depending on what the date is when you're opening this spreadsheet. I've just changed it to September. I refresh that. And we should see the numbers change just a little bit because now we're pointing to a different time period. You can see that coming through in our review panel over on the left-hand side. So very powerful. Excel still has a place, and it's like I said, it's quite easy to learn. It's drag and drop, and no need to learn a new coding language or anything complicated like that. So I'm going to go back to our slide pack now. So I guess in a way, we've only really scratched the surface today, but I hope that in the time that we've had, hopefully that gives you a bit of an appreciation of the capabilities that live within Adaptive. And before we do wrap up, we do want to tackle some Q&A. So I'm going to hand back to Dave, who is, I guess he's going to moderate our Q&A from here. So over to you, Dave.
Thanks, Kieran. Hopefully that's given everyone a bit of a picture of how powerful Adaptive can be. We've got some questions here which we'll get to. We've got about 15 minutes left. So if there's anyone else who does have any other questions, please post them. Potentially, we may be able to give you some time back otherwise. So first question here, Kieran, is with COVID, have we seen any change with businesses and the willingness to implement systems like Adaptive? So I can answer this one. I think it's kind of a twofold answer, which is yes and no. So on the one hand, yes, we've certainly spoken to businesses that may have the need for a system like Adaptive, but have indicated, the time isn't right with everything else they have going on in the business. But on the flip side, and I kind of touched on this with one of the examples that I gave of a client that we've implemented for, is that COVID, in some respect, has brought to light some of the inadequacies in planning processes and the ability to look at different scenarios to inform strategic decisions. And I think to some extent, some businesses have known that was there in the background, and we could kind of get away with it, but COVID has really shone a light on that. So I think for some businesses, it's really just provided impetus to look at alternates and systems like Adaptive. All right, we've got another question here, and I think, Kieran, this one might be for you. In terms of the reporting, why would you consider using Office Connect as compared to the reporting within Adaptive?
That's a good question. So hopefully I gave you a bit of a sense of the capability there in Office Connect. So some of the benefits, I guess, people like to use Excel, so it is familiar. One of the really good things that it can do is, I guess, set some standards and some consistency between things and take away some of the rework that you do. And I think we've sort of touched on it a little bit today, but if you can actually use Office Connect, they say Office Connect, I've only shown you Excel today, but it is applicable to Microsoft Word and Microsoft PowerPoint as well. And a lot of organizations have regular reporting, whether it's monthly, quarterly, preparing board packs. So where we can really tap into the Office Connect add-in is we can set up those reports once and then just refresh those figures on a monthly basis or quarterly basis. So it is reducing some of that workload. You're not constantly having to do that manually. So that's probably one of the big wins, I guess, I see out of Office Connect. But yeah, the other one, I guess, would be just working out of Excel. I think there is a reluctance to move out of Excel. So there is still a place for it working with Adaptive.
All right, thanks, Kieran. We've got one more question here, so just give everyone a few more minutes if there is any other questions. This question, Kieran, I might throw to you as well, but it's essentially if you have hundreds of, say, assets or leases, can you model them? Can you bring them in and model them in Adaptive individually and feed them into your planning process?
Yeah, you definitely can. Not sure that I would recommend it. I mean, it's case-by-case basis, but what we've typically seen in the past is we don't want to replicate what happens in an ERP or finance system. We don't want to be trying to copy a fixed asset module. That functionality works fine in the source system typically. So what we'll typically do is bring in balances for fixed assets and depreciation. And what we'll do, what you saw today, the capital example that I showed, we would typically handle the additions in Adaptive rather than trying to replicate what's happening in the source system. So hopefully that answers the question.
Yeah, great. Thanks, Kieran. Just had one more come through around the cost of the system. So good question, thank you. So it's dependent on a few things, which I'll speak to, but then I'll try and give you a helpful answer. So it depends firstly on the size of the business. So as Adaptive has some different pricing based on the number of employees, and that first rung of pricing is for businesses with 300 or less employees. So we say it also, depends on what you actually need in Adaptive. But to give you some guidance, if you have less than 300 employees, which we typically say an average is around $40,000 per annum. The two of the clients that we've recently implemented for were closer to $30,000 per annum. And again, I'd say it really depends on what you require to be done in Adaptive. So this is the system cost that I'm referring to, and then there's an implementation cost associated, and that typically is in the range of a one-off cost of kind of 1.5 to 2 times the system fees, just to give you a bit of a guide. If you are a larger organisation, more than 300 employees, the pricing is higher than that. And you're probably looking at something more like $70,000 per annum. All right. I don't think we've got any other questions at the minute. Look, thank you for joining us today, Kieran. I might get you to flick over to the next slide. There's our contact details if you'd like to reach out if you have any further questions. If you've seen some things today and you're trying to understand whether Adaptive might be something that's right for your business, we're happy to talk to you, understand your requirements, and help you think through whether Adaptive is the right fit. And we can also provide demonstrations which are more tailored to individual organisations. So thank you again for joining us today.